Two men walked into the same bank in 2001. Marcus was 31. Daniel was 32. They grew up in the same neighborhood, went to the same state university, got jobs in the same industry. And on that particular Tuesday morning, they each deposited their first real paycheck, almost identical amounts, into nearly identical savings accounts. By 2019, one of them retired early, moved his family abroad. His money was working while he slept. The other one still goes to work every morning. Not because he loves it, because he has to. His salary doubled over those 18 years. His lifestyle tripled. And somehow, with every raise, every promotion, every upgrade, he ended up with less room to breathe than the day he started. Same neighborhood, same degree, same bank, same decade. Two completely different lives. The difference wasn't income. It wasn't luck. It wasn't timing. It was a handful of money decisions most people don't even recognize as decisions, that one of them kept making past the age of 30, and the other quietly stopped. This isn't about budgeting tricks or cutting your morning coffee. This is about the invisible financial habits that feel completely normal in your 20s, but become quietly devastating in your 30s, 40s, and beyond. The decisions that don't hurt today. The ones that hurt you 15 years from now, when you finally realize the window has been closing this entire time and you never noticed. I'm going to show you the money decisions that silently separate people who build wealth from people who build the appearance of wealth. These aren't obscure strategies. Most of them are patterns you're already living, and once you see them clearly, you cannot unsee them. Let's start from the beginning. Rule 1. Rule 1: stop trading time for money as your only financial strategy. There's a hard ceiling on how much time you have. There is no ceiling on how well that time can work for you. Most people spend their entire working life selling hours. 40 hours a week, multiplied by an hourly rate, multiplied by 50 weeks a year. And the solution they're sold is simple: work more hours, earn a promotion, get a higher rate. It feels like progress because the number goes up. But the model has a structural limit. You only have so many hours, and at some point, trading more of them doesn't fix anything. It just delays the conversation you're not ready to have. The people who actually build wealth don't replace this model overnight, but they start building alongside it. A modest rental income, dividend-generating assets, a skill that scales beyond one-to-one service. They start asking a different question: how can money work while I'm not working? But here's what most people miss. The damage isn't only financial. When your only lever is working more hours, you also lose time, the one thing money is supposed to eventually buy back. By the time most people understand this, they've already spent the years they needed to build it. Rule 2. Rule 2: stop upgrading your lifestyle every time your income rises. This one is quiet, comfortable, completely socially acceptable, and it is one of the most financially destructive patterns that exists. When you're 24, you earn a little, you spend a little, and nobody holds it against you. When you're 31 and you get a promotion, something shifts. The car feels a bit outdated. The apartment feels a bit small. The vacation you used to take doesn't feel like quite enough anymore. And so, with every new income level, comes a new version of your life, a new standard of normal that immediately consumes the difference. Economists call this lifestyle inflation, but that name is too clinical for what's actually happening. What's actually happening is that you're converting your future freedom into present comfort every single month. Think of it this way: if your income increases by $800 a month and your lifestyle expenses increase by $750 a month, you've technically made progress. But you've spent 94% of your raise before it could work for you. Over 10 years, that gap between what you earned and what you could have built becomes almost impossible to close. It gets worse. The lifestyle gets locked in. The bigger apartment has a lease. The newer car has payments. These aren't flexible expenses anymore. They're commitments. And once your life hardens around a certain income level, any disruption, a job loss, a health issue, an economic shift, doesn't just inconvenience you, it unravels everything at once. Rule 3. Rule 3: stop assuming your home is your retirement plan. Nobody talks about this the way they should. Homeownership is a meaningful milestone, but it is not, on its own, a wealth-building vehicle. And treating it as your primary one is a mistake that quietly costs people decades of compounding. Here is what owning a home actually looks like financially. You pay a mortgage, significant interest in the early years. You pay property taxes, maintenance, repairs, insurance. And the house itself, unlike a diversified index fund, is a single concentrated, illiquid asset in one geographic market. It cannot be partially sold, it cannot be rebalanced, and it doesn't produce income unless you rent part of it. The psychological trap is that homeowners watch their property value rise and feel wealthy, but that wealth is trapped. You cannot spend it without selling, and if you sell, you still need somewhere to live. Meanwhile, the opportunity cost is real. The down payment, the extra renovations, the capital sitting in equity, all of it, invested consistently in a broad market index over 20 years, would in many cases have compounded into something far more useful and far more accessible. The house is a place to live. That's genuinely valuable, but a retirement plan. It was never built for that job. Rule 4. Rule 4. Stop making investment decisions based on what everyone around you is already talking about. The most expensive 4 words in personal finance are, everyone is doing it. Whether it's a real estate market at its peak, a stock that's been on the news 3 nights running, a cryptocurrency your colleague won't stop mentioning at lunch, or a business opportunity your neighbor swears is about to change everything, the pattern is always the same. By the time something becomes a dinner table conversation, the early gains are usually already gone. This is not cynicism about every opportunity. It's about understanding where you are in the information cycle. When something becomes culturally visible, when your parents are asking about it, when your barber is mentioning it, that's usually the moment when the people who got in early are quietly thinking about getting out. The psychological mechanism is social proof. We are wired to look at what others are doing as a signal of what's correct and safe. In social situations, this instinct serves you. In financial markets, it almost always works against you. The investors who build long-term wealth tend to be boring, low-cost index funds, consistent contributions, no dramatic moves, no timing the market. They're not at the dinner table discussing their portfolio because there's nothing exciting to report. And that's precisely the point. Rule 5. Rule 5. Stop paying the minimum on consumer debt and calling it managing your finances. This one deserves a number. If you carry a $5,000 balance on a credit card at 18% annual interest and you make only minimum payments, you will pay that balance off in roughly 16 years. You will pay approximately $5,000 in interest alone. You borrowed $5,000. You repaid $10,000. And this is considered the responsible option, because at least you're paying something. Consumer debt is not neutral. It is not simply borrowing from your future self. It is actively working against every other financial decision you make. The returns you're trying to build in your investment account are being quietly eroded every month by a double-digit interest rate on a balance that grows faster than you expect. Nobody tells you in your 20s that the minimum payment is designed to keep you paying as long as possible. It is not a repayment plan. It is a profit model for the lender. After 30, carrying consumer debt isn't a phase. It becomes a financial identity. It limits the risks you can take, the opportunities you can pursue, and the breathing room you have when life, as it always does, disrupts your plans without asking permission. Rule 6. Rule 6. Stop waiting for the perfect moment to invest. The perfect moment doesn't exist, and waiting for it has a very specific, calculable cost. If you invested $1,000 at age 30 in a broad market index fund and left it untouched, historical averages suggest it could grow to somewhere between $7,000 and $10,000 by age 65. If you waited until age 40 to make the exact same investment, that number roughly cuts in half. Not because of what the market did, because of the decade of compounding you skipped. This is the rule that sounds simple and feels complicated when you're living it. The market feels uncertain right now. Things seem unstable. You want to wait until you understand it better, until you have more to invest, until you feel confident. But the market is always uncertain. There is never a calm, quiet moment where a voice tells you the time is right. People who waited for that moment in 2009 missed the largest post-recession bull run in modern history. People who waited in 2020 missed one of the fastest recoveries ever recorded. Starting matters more than timing. Consistency matters more than perfection. The investor who contributes steadily through both highs and lows nearly always outperforms the investor who tried to find the perfect entry point. I'm not done yet. The cost of waiting isn't only financial. It's psychological. Every year you delay, the goal gets heavier. The number you need grows, the window shortens, and the story you tell yourself about why you haven't started yet becomes harder to stop believing. Rule 7. Stop measuring your wealth by what other people can see. There is a version of financial success that is entirely performative, and it is extraordinarily expensive. The newer car in the driveway, the renovation your guests notice when they visit, the vacation photos that signal a certain kind of life, the watch, the wardrobe, the restaurant. None of these things are wrong on their own. But when they're driven by the desire to signal financial success rather than actually build it, they create a loop that never closes. The psychological pattern works like this. You spend to signal status. Other people see the signal and raise their own. You see their raise and feel behind, so you spend again. Meanwhile, the people who are genuinely building wealth are almost invisible. They drive used cars. They live in the same house for 12 years. They don't talk about money at dinner because their money isn't on display. Decades of research into actual millionaires, not the ones who look wealthy, but the ones who are, produced one counterintuitive finding that keeps repeating itself. Most people who appear wealthy are not, and most people who are wealthy do not appear to be. After 30, every financial decision you make is a vote. A vote for the life you're building in private, or the image you're maintaining in public. You don't have infinite votes. And everyone you cast in the wrong direction is one you cannot cast somewhere that actually matters. Rule 8. Rule 8. Stop treating how you're taxed as someone else's problem. Taxes are the largest single expense most working adults will ever face, larger than housing, larger than transportation, and most people spend less than 2 hours a year thinking about them. This isn't about complicated maneuvers. It's about the fundamentals most people ignore entirely. Contributing to a tax-advantaged retirement account, even modestly, changes your taxable income in the current year. Understanding the difference between short-term and long-term capital gains changes how much you keep when you eventually sell an asset. Knowing whether a traditional or Roth structure better fits your situation could affect your finances significantly across 2 decades. The people who say they don't know enough about this and then leave it there, that decision has a cost. A qualified advisor, a solid resource, a single afternoon of real attention, these are not luxuries reserved for the wealthy. They're the difference between keeping more of what you earn and quietly handing it to a system you never took the time to understand. Let's go back to Marcus and Daniel. Same salary, same starting point, same neighborhood, same decade. But in the years after 30, their decisions began to quietly diverge in ways that were almost invisible from the outside. Daniel upgraded his lifestyle with every raise. He bought a house and called it his retirement plan. He paid the minimum on his cards because at least he was paying. He invested when he felt confident, which was rarely. He drove a car that said he was doing well. And every year, his income grew, and somehow the margin between what he earned and what he kept stayed almost exactly the same. Marcus made different choices, not dramatic ones, not the kind of choices that make people look at you differently. He kept his lifestyle modest when his income grew. He invested consistently, not perfectly. He paid down debt aggressively, and then redirected that money into assets that worked without him. He didn't talk about money at dinner because his money wasn't for display. By 2019, they were both in their early 50s. One was in Portugal. One was still at the office, not because he'd failed in any obvious way, but because the window had been quietly closing for 20 years and he had never noticed. The decisions that created those two outcomes weren't made at 50. They were made at 32, at 35, at 38, in the quiet, ordinary Tuesday moments when nobody was watching and nothing felt like a turning point. Most financial mistakes after 30 don't announce themselves. They arrive as perfectly reasonable choices, comfortable choices, the kind of choices everyone around you is making. They feel like the normal thing to do. That's exactly what makes them dangerous.